Modern day reverse mortgages. Should we love them or should we hate them? So today we have a special guest, Brooke McManus, who's with Longbridge Financial. She's an account executive and an expert on these reverse mortgages. So welcome to the show and thank you for joining us today, Brooke. How are you? How are things out in Denver in your area?
Thank you. Great to be here. It's sun shines out and enjoying the mountain life.
Always sunny in Colorado, huh? um,
Always sunny.
So I want to kind of jump right into the meat of it to start and just look at the kind of the facts versus reality of in the old days, these were seen by us advisors and by a lot of consumers that reverse mortgages were very expensive and borderline predatory for some of the products. But that was years and years and years ago. And now they're very mainstream. And I look at them as actually a great product that can really transform somebody's life in the right set of circumstances. But we wanted to get a better idea on the expense. So what are the expenses in a reverse mortgage and are they needed? Are they fair? So what are your thoughts on how these are structured and the expense in particular?
Sure. I think reverse mortgages have had there's a big misconception about them. The bank owns my home. The bank's going to take my home. They are very expensive. Here's the thing that there is a cost to this loan, just like every loan out there. There's a cost associated with it. One of the benefits of a reverse mortgage is there is no mortgage payment required. And a lot of our borrowers that come to us are needing some sort of relief or help in a certain situation. And this product gives them some relief. It gives them another funding option to improve their life. And that's what a reverse mortgage is designed for. It's not for everybody, but it is a great product for a lot of people out there who need it.
So I've seen firsthand how this can transform somebody's life. When I first got involved, this was years ago, and I think Wells Fargo had just entered the space, so the mortgages were getting better. And I had a neighbor of mine who had a beautiful old house, but it was pretty run down. She lived on Social Security, and that was it. But she had a very expensive house, paid off in full. And she was asking me to help her a little bit with her finances. So I went through things, and she really didn't have any resources. So we went down this path, went through the counseling and everything that's required to get a reverse mortgage. And it fit her perfectly. And ironically, her kids kind of came forward to make sure everything was okay because they never paid attention to her. But since their inheritance was now going to be affected, they all of a sudden had an interest. Well, mom ultimately did this, and she did a version where back then she got a monthly payment, which pretty much doubled her standard of living from Social Security to also getting this monthly payment. And I'll never forget, she was most excited about just being able to afford to take a bus trip to Reno with a lot of her little old lady friends that like to do that for entertainment. And she was able to afford hair. So if you're like me and have no hair, I'm just used to it. But her hair was very thinning and she was able to afford a wig. And she was so happy. And I did all this for trade. And the trade was she used to bring me baked goods, and she did it for years. She brought me baked goods once a month. She'd bring them into the office for everybody. And it was the most fulfilling thing because it completely transformed her life. And her home just kept going up in value. So really the equity, the kids were all protected. And it was a phenomenal solution for her. There was cost to it, but it made sense. So it can transform lives, and that's a traditional use. And I know we're going to talk about some less traditional uses also. But the cost, let's try to understand why it's more expensive a little bit. And I know you talked to me in a prior call about the mortgage insurance. So can you tell our listeners what the mortgage insurance is, why it's required?
Sure. So on our traditional HECM product, HECM is a home equity conversion mortgage. We have mortgage insurance that is required on these loans. So there's 2% of the value of the home that's charged up front, and this is all wrapped into the loan. So there's no out-of-pocket cost for the mortgage insurance. We also charge 0.5% annually. That's wrapped into the rate of the loan balance. Now, the mortgage insurance
And that's for the mortgage insurance.
Correct. Correct. And the mortgage insurance it's a safety net. So these are non-recourse loans. So to educate your listeners, a non-recourse means you'll never owe more than what your home is worth. So if we take it back to 08, 09, 010, when we had the crash, a lot of borrowers, homeowners, became upside down in their homes, right? The market crashed. So now their home was worth less than.
I remember that.
Yeah. And so this is a protection. So if that ever happens where your home becomes less than more than you owe more than what your home is worth, it's non-recourse. So that's a protection that is available in Wame products.
Yeah. So to play that out, let's say, I know at the depths in San Francisco, their home value is down 70%. So if somebody had done a reverse mortgage and their balance is accumulating, let's say they're at 60, 70% loan to value, and their home was worth $1 million, this crash occurs and it's worth $350, but they owe $600. What this allows them to do is they could walk away from the home and the mortgage, and the bank can only take the home back. They can't go after any other assets. Nor if somebody passed away and their kids are now inheriting this property, if it's upside down, the bank can't go after the estate or anything other than the house. So that protection gives you some real value, so you don't have to worry about your other assets. And if that did happen, to be honest, this borrower is probably the big winner because they were able to get a lot more out of their house than it's worth when the kids may be forced to sell in an estate or something. So give some context to this. Let's say it is a $500,000 home. You're saying that there's an upfront fee of $10,000 that is straight. That's not even a cost of the loan or the bank doing business. It's just the mortgage insurance rate would be that $10,000 initial fee that would be baked into the loan. Is that a fair statement?
Yes.
Okay. And that I think is part of why people feel like these are expensive, is because of those mortgage insurance fees, and because you're looking at the bank's looking at how much are you going to borrow over your lifetime, not just how much are you borrowing today. And then some of the bank fees, are they based upon that ultimate dollar value of what you're going to borrow?
Well, other fees associated with the loan. So there's no lender fee. So we don't charge a lender fee. There's title and escrow fees like you would pay on a traditional forward loan. So you've got title insurance, you've got the settlement fee that are included in the cost of the loan. Obviously, appraisal fees. So that's typically a fee that's paid out of pocket by the borrower or potentially the broker. And then the counseling fee, that is actually a requirement that the borrower has to pay the counseling fee. So there's no credit associated with the counseling fee. And that's typically runs around $125, $150, but you could definitely shop around for the counseling. There's a ton of counselors on the HUD website that these borrowers can go to and do some shopping.
Okay, so Brooke, on these loans, like with a traditional loan, a lot of times the broker that's helping a client can choose a rate. Higher rates would have low or no points. Sometimes you even actually get a rebate. And a lower rate might involve points. Now, in talking to you, it sounds like this is more of a spread product, meaning there are no points ever in this product. Is that a correct statement?
Correct. There's no points associated in a reverse mortgage. There's a margin that's involved in the interest rate that you and your broker would then negotiate what that margin would look like.
Sure. And the banks are going to make money. So obviously everybody's got to get paid somewhere. I think for listeners, one thing that you want to be aware of is make sure that your broker shows you all the options. So when we go through this, we help analyze, because the mortgage broker has a choice of paying themselves a lot more by choosing a product that is not as good for you. Or they can choose the most competitive option, which they should always choose for you. And if you're working with somebody that tries to get paid more, fire them and hire a better broker. So as a financial advisor, we look at ourselves as kind of advocates for our clients. So we go through and we make sure that they are always getting that best deal. And we won't work with a broker that's going to charge the higher amount just so they can get paid more, because they're getting paid a little bit, and the consumer, meaning the borrower, is paying a lot more. So it is important to choose your broker wisely because they are able to charge you more if you're not careful. So that's a whole separate conversation. But let's get back to the actual product. Let's talk about some of the areas where this can really benefit a client. So I told you about my neighbor. That I think is the most common thought process is, I just want to get rid of this mortgage so I have an extra $2,000 a month for my retirement. And that can be life-changing for somebody that has run out of money and they're living on Social Security. But what are some of the other powerful uses that you've seen for either the lump sum reverse mortgage or for the what I refer to as the line of credit type product?
The line of credit is one of the biggest benefits of the reverse mortgage. So that's the adjustable product that has the line of credit option is our bread and butter. That's what we sell 95% of the time. The benefit of the line of credit option is that it gives, not only does it have a growth rate, and we can talk a little bit more about the growth rate that is associated with the line of credit, but it gives the borrower a little bit more flexibility of being able to tap into their equity when they need it. So instead of getting a lump sum of $50,000 at closing, because a lot of borrowers, well, I don't really need 50 grand right now. I can use it in the next year, but I don't really need a lump sum of $50,000 today. So what you can do is you can put that 50 grand in the line of credit and access it as needed. So what we deal with a lot is a lot of borrowers have increased medical costs. So what we're seeing a lot is we use the term age in place. Our borrowers want to stay in their home. They don't want to go to an in-home care facility. They want to stay in their home because it's comfortable. It's what they know. They've got their family close by that can help out. And so the cost of in-home care is extremely high. So we've seen ranges from $5,000 a month to near $20,000 a month for in-home health.
We deal with that regularly. Yeah.
So the kids are saying, well, I'll help a little bit, but I don't know if I can help for all of that. So the benefit of the reverse is to be able to access the equity of the home to help with those costs. So that's where the line of credit comes in and is so beneficial, because you can take, let's say, $5,000 one month. Maybe the next month you need a little bit more. You can then pull maybe $7,000. It makes it flexible.
You shared an interesting chart, but it shows the increasing amount of the line of credit over time, which is very, very powerful. We do a lot of asset-based long-term care planning, which basically is there's strategies that are not use it or lose it, meaning you're going to probably get better than bond-like returns anyway, but if you need long-term care, you get some leverage and you get some extra monies for long-term care. I see this line of credit as a tremendous safety net. Now, there's cost to it, of course. So if you never use it, you didn't waste your money on all the fees, but you got a sense of security that you never needed, but that had value even if you didn't use it. But with long-term care, 60% of the people roughly won't ever use it anyway. But if they need it, this could be something that could save them and their kids and have resources available when you need that. And if they don't need it, then the equity is there for the kids. So I see it as a powerful emergency net for things such as long-term care, but then also for things like inflation. So if you get to where you're fine where you're at, but you know that you're on a fixed income and inflation is going to eat away at your income, this line of credit can give you that extra buffer to where if you need to pull out a few thousand a year to deal with inflation, it could help there also. Now, one important thing you told me in a previous conversation that I want to ask you about is you find that banks close down your traditional equity lines of credit right when you need them, meaning in a recession, when things are bad, they then have the discretion to just close your line of credit down. And I think you had stated, and please confirm or correct me if I'm wrong, that once this is in place, the banks have no ability to shut you off. It's your money. They cannot close it down in bad economic times.
Correct. We saw it during the pandemic. HELOCs were frozen. You were not able to access your HELOC during the pandemic. And in reverse, you are protected. That money is always going to be available to you.
Yeah, that's powerful. I experienced this in the 2010 crisis where we had a home that was completely paid off, valuable. There was zero risk for these banks, yet they closed my line of credit, which I would have access to buy more homes. So banks are not the smartest entities, and it's not their fault. It's that they are so regulated that they make bad decisions. And we saw this in extreme with the crisis where they kick all these people out of their homes, sell them off for a discount to the hedge funds. And all they had to do was partner with these homeowners, and they could have made it better for the homeowner and better for the bank. And they know this. It's not that they're dumb people. It's that they are regulated so much that if they have bad assets on their books, they are extremely incentivized to get them off the books because their business is multiplication and leverage of money. So there's reasons behind why they make dumb decisions, but at the end of the day, they're dumb decisions that hurt people. And this product, they don't have that ability. This emergency net, this line of credit is there when you need it, and they can't take it away. And to me, that is extremely powerful as a emergency reserve for clients. This is a product I don't use that much in my practice because we have a lot of high net worth clients, but it's something I should use more because it's there just in case. And a lot of people are okay with paying that $10,000 or $15,000 fee so that they know they have access to their $250,000, $500,000 of equity, whatever their limit is based on the size of their home, which we have expensive homes in this area. That could be very valuable. So I see this line of credit as an underutilized tool that all of us financial advisors should consider more often for their clients.
I agree. And I don't think that it should always be a last resort option. I think that's been a thing of what a reverse is. Oh, it's the last resort. I have no other options. I'm now, head underwater. I'm on a fixed income. I've got all of this credit card debt, and now I should consider a reverse. I think that the mindset's starting to shift. I think that this loan is not designed just for those people. We are experiencing a larger volume of high net worth borrowers coming in to use it to leverage their portfolio and to tap into their equity, because we all know you're not taking your home with you to your grave. It's just an asset sitting there.
We know that for sure.
One of my financial advisor, he calls it a dumb asset. It's a dumb asset. It's just sitting there doing nothing for you. And so
we call it a lifestyle asset. So it's not part of your portfolio. We don't even count it as part of your portfolio. It's a lifestyle asset. But this can turn a lifestyle asset into actually an asset that is part of your portfolio. We talked about volatility buffers, and we talk a lot about that with our clients, that when the stock market is down in particular, we do a variety of strategies to make sure that they're not having to tap those resources. This is something that you had mentioned again in a prior conversation, that's a potentially good use also, that if you have this money there, and you could do it by design, that when the market is down, you're going to not take it out of your portfolio. You're going to tap your line of credit. I have a question for you on this that I didn't ask you before, because I think that's a great way of doing it. Like we like to protect it before you get to that trouble spot, quite frankly, but this is a good backup. But if you did that, so let's say you incorporated this as part of the financial plan as what I call a volatility buffer, can you pay down this line of credit and then you automatically have access to that money again?
100%.
Okay, so it does work like a traditional line of credit. And then once you pay it down, it will start growing again if you're not using it.
Correct.
Yeah. There's a lot of uses for this line of credit that's gone so far beyond what we did for my neighbor way back when. The line of credit, I can see it working as a great volatility buffer, a great part of long-term care planning. Still using it for emergency reserves, and then just traditional. If you need an extra $1,000 a month, you tap it at $1,000 a month, but you're not paying interest until you take it out. So that's I think the use is great. Let's talk about who can use it. So the ideal client, how old do they need to be in a modern day reverse mortgage or line of credit?
62 years old for our traditional HECM FHA product. So if you have a married couple, at least one spouse has to be 62. You can have a 62-year-old and a 50-year-old, but just know that we do use the age of the youngest borrower. So that's the consideration of the youngest borrower. Obviously, the idea is that they're going to live longer. So we have to adjust the loan to value based on the youngest borrower.
Is there an ideal time to get this to maximize how much of your equity can get? Or is it just grow? If you get it at 62, just get it at 62 and it's going to grow anyway if you're not using it? Or is there an advantage of waiting until you're 70 as an example?
Well, our LTVs, or we call them principal limit factors, are based on the age. So the younger you are, the less equity you have access to. So I wouldn't say wait. I think it's more of today, what does your financial portfolio look like? And would it be a benefit right now to tap into your equity and start the line of credit growth rate or the line of credit option? So yes, the older you are, the more access you get.
Once they pay the upfront fees, let's say they have a zero balance and they don't need it for a decade, but they've set it up, it's growing over that decade. Are they paying any fees each year when the balance is zero?
No fees associated with that.
So if I'm 62 and I set it up, am I going to have access to this, presumably the same amount of equity as if I just got it at 65? I mean, it'll grow from 62 to 65 to those numbers.
I haven't thought of it that way, but that could potentially, you can see the growth increase. And that would be an interesting graph, honestly, Terry, to look at to see what that increase would look like at 62, 65, 70, to see if it matches what those LTVs are at that age. I haven't thought of it that way.
Yeah, I think maybe I'll get together with you after this. We can run some case studies, but because a lot of things that we do have optimal ages. That you don't want to do it till you're 65, for instance, for some of the income benefits. You want to, if you do it at 63, 64, you're kind of disproportionately being hurt. Whereas if you wait until that sweet spot, and for a lot of clients, we have the choice. So maybe waiting is a good thing. But I'd be curious to see what those numbers look like. Because I do like the line of credit in particular.
Yeah, I do want to point out, we also have a proprietary jumbo reverse for values over 1.1 million. And that age actually goes down to 55 years old, depending on the state. So
I can qualify.
State specific, but yes, we can go down to 55.
Okay. And is that a line of credit type product also?
Yes, it does have a line of credit. Okay. The growth rate on that one, because it is a jumbo, is only 1.5%.
What's the growth rate typically on a traditional non-jumbo?
Right now, we're seeing 6.5 to 7%.
Oh, wow. That's great. Okay. So if you're, and I could do some quick math, I guess, to see how that would work out if you get it at 62 versus 70 with a few case studies. So that could be, that's a great growth rate. Is that locked in at the time that you borrow, or does that vary year to year based on the interest rate environment?
It will vary month to month based on, we use the CMT, the constant maturity treasury. That's our index that we use. Okay. So it is attached to the constant maturity treasury. So it will fluctuate every month.
Okay. And rates are historically at least pretty low. So if you're at that kind of a rate now, if we ended up in the 70s where you're getting 13% on your CDs, you're probably growing at a pretty nice pace, I would assume. We'd have to look at that index historically, but yeah. Okay. What about the type? So is everything variable, or do you have fixed products as far as the interest rate?
We do have fixed products, and it just gives you access to less equity.
Yeah, and the line of credits presumably are all variable. They're not fixed. Is that a fair assumption?
Correct.
Okay. And that's where I see so much power in this. I really, as you pointed out to me, you're like, that's really the most popular, and it's for these reasons. So I think that makes a lot of sense. we started to talk a little bit about the process earlier. And this isn't a loan you just go to the bank and get, or go to a mortgage broker and get, which Matt in our office does these. If somebody is going to do this, can you walk us through what the steps are, including the counseling? Because a lot of the listeners aren't even aware that you have to do counseling, but what are the steps to getting a reverse mortgage?
Sure. Just making sure that it's a fit for you today. So working with your broker, loan officer, and just having a conversation of what your needs are. Once you and your loan officer go back and forth of the product, so choosing your product and explaining the amount of available funds that you have, the max that you can take at closing, the line of credit option, you would then go to counseling. So your broker would provide you with a list of at least 10 counselors that you would call from, and you would set up an appointment. It's all over the phone, which is great. It takes about an hour. They'll answer a lot of your questions. They'll go through the basics of a reverse just to make sure that you're understanding the basics of the product. And what's great is that it's a third party, right? It has nothing to do with us as a lender, has nothing to do with the broker. So this is a third party. You find them on the HUD website. You can even go on the HUD website and Google counselors, reverse counselors, and look on there. So they're just wanting to make sure that the borrowers are understanding the basics of the reverse.
Yeah. And this dates back to when they were, in my opinion, anyway, they weren't such a good product when they started. They were a bit predatory. So the consumer is being protected now through this counseling process, and it's continued on to this day, because it is important to understand it, but now they actually are much more fairly priced, and it's a much better product. So that may be something that someday we see it going away, but a lot of these legacy protections tend to live on. But I think it's great that they're getting a third party to answer their questions so that they're getting unbiased information, because like anything else, there's good brokers and bad brokers out there, and you want to make sure it fits well and that the money that you're investing in these fees and expenses are worth it. And when it fits, I think it's great. So that's I think a valuable step in the process.
I agree with you 100%. So once the education course is completed, counseling is completed, you would get a certificate. The borrower would get a certificate. They would sign it and send it over. And then it's very similar to a forward loan. So we would collect supporting documentation that we need for the loan, and then go ahead and submit the file. We would order title, appraisal, get it moving into underwriting, work on conditions, and then work to closing. So typically around 30 to 45 days for these loans.
Okay. Not bad at all. I just thought of another use. We do a tremendous amount of tax planning. And for seniors, there's strategies where you front load income to one year or another, and it can make a meaningful difference in the taxation of some of your benefits, and such as Social Security. With this line of credit, you could actually do that and access the line of credit as you need it in order to do the tax planning, then pay it off in the year that you're bringing in more income. So every other year, you cannot pay taxes on your Social Security by doing this in the right situation, by accessing the line of credit, paying it off, accessing it, paying it off. Are there fees when you access your line of credit?
No, not on the traditional FHA HECM product. No, on my jumbo proprietary product, it's a $20 monthly fee.
Okay, so you could, this could be a powerful tool. I'm glad we had our prior conversation, and thank you for joining us today. I can see a lot of different ways it could potentially help us to help our clients engineer their financial plans more effectively. Any other areas or things you wanted to talk about, or you think our listeners should hear about?
We also offer a HECM for purchase, reverse for purchase. So I think it's becoming more and more popular. I think, a couple of years ago when the market was so competitive, I'm sure in your area, I know in Denver, we were cash offers, quick closings. So the reverse was a little bit more challenging to use as a funding option. But I think now that the market's slowed down, now that we've gotten the process more streamlined, HECM for purchase, our volume has increased dramatically. So people can actually get a reverse mortgage purchasing a home. And basically what that looks like, I'll kind of do an overview for you. So most borrowers own a home. Okay, so they either want to, we call it right size. They want to right size to maybe move closer to family. Maybe they want
single story.
Single story. They want to move into a home that they don't have as much maintenance or whatnot. So they typically own a home and they're going to sell that house to then purchase a new home. So let's just say, keep it easy. Maybe you own the home free and clear. Maybe there's $100,000, $200,000 lien on the property. Okay, so you're going to have a net of $500,000, $400,000 that you have to put down in this new home. A lot of people we see, they just put a cash offer, right? I've got $500,000. I'm going to buy a $500,000 home. I'm just going to put all of my net proceeds into this new house. Well, what if there was another option? That instead of putting all of the cash into the new home, you put 60% down and kept 40% of it for credit cards, repairs, travel. The list goes on. And now you have a reverse mortgage, no mortgage payment required. No mortgage payment required. You put 60% down and now you've got the rest. Versus, okay, so now you could either do cash offer or you can go get a forward loan, right? We can talk about a forward loan. Typically, I think people put maybe 5-10% down these days, traditional loan. You can put 5-10% down, but you have a mortgage payment required. A lot of these seniors do not want to have to make a mortgage payment. So that's the benefit of the reverse.
Yeah, we actually have one we're working on that is that. One of my clients that actually got Matt involved in, that's they're weighing the options now. On those, let's say you're going to put down, for whatever reason, you want to put down 80% and have part of that be a line of credit. Can you do that combo?
Absolutely.
Okay,
I'm actually
perfect.
I'm just closing one right now where the borrower is funding her line of credit. So she has an additional $50,000 that she wants to put into her line of credit for the purchase. So I think it's a great option.
Okay, great. Well, this has been enlightening. Thank you for spending some time with us today. And if the listeners are interested, you can just reach out to me at Terry at wearaadvisors.com or go to our website at www.wearaadvisors, and we will get you connected. We work with Brooks Group. Matt is our loan officer in a company that we own called We Direct Lending. And we can do loans of that nature, and we can make sure that you're getting the low cost option and that you're getting it structured properly. So thank you so much for your time and for joining us. And I hope you enjoy Denver and have a wonderful sunny day there, and enjoy the weekend.
Thank you, Terry.
Thank you for listening to We Money Talk with Terry Wheeler. Be sure to click the follow button to be notified as new episodes become available. Information presented is for educational purposes only. No listener should assume that any discussions or information presented serves as the receipt of or substitute for personalized advice from We Alliance Wealth Advisors, Inc. or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. We Alliance Wealth Advisors, Inc. is not a law firm or accounting firm, and no portion of this podcast should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not appropriate for every individual. Listeners are encouraged to seek advice from qualified tax, legal, or investment advisors to determine whether any information presented may be suitable for their specific situation.